Good evening, everyone. How are you all? Doing good? Fantastic. I can see the answers of my previously given assignment ready over here. Shreya, Ms. Shreya Shah. Nice that you have solved the question that I've given in that last class. Okay, so let me just put up the answers for Plan 1 EPS is 12.5. Okay, Plan 1 EPS is 12.5. For Plan 2 EPS is 13.75. For and when it's 8,58,76, plan 1 and plan 2 EPS, both are 15.01. Okay, just verify, guys. Are you getting the same numbers as Shreya has got? Then for plan 1 and 2 for 9 lakh EBIT, we have EPS of 16.83, and that's 15.925. Okay, just verify. Anyone from the other guys? Are you getting these EPS numbers? Are these 6 EPS being obtained by you? Yep. We getting these numbers, everyone? Yep. So fine. I think others have also got it. And these numbers actually are a testimonial to what we have discussed in the previous class itself. Remember, I told you that when your EBIT is less than indifference point, then the plan which is less risky, that's suitable, right? And when it is beyond the indifference point, then the plan which is more risky is suitable, right? So as we have seen over here also, then 8 lakh was the EBIT, which is below this. We find that it is 12.5 for plan 1 and 13.75 for plan 2. Accordingly, this is the best one. And at 9 lakh level, we say 16.83. 16.83 is the over here. 16.83 is the best, is the highest EPS. So plan 1 is suitable. And that's what we are observing over here also. 8,58,076 was the indifference point. And beyond that, we say plan 1 is a dominating one. Plan 1 dominates over here, right? And below that, plan 2 dominates. Below that, 13.75, we see plan 2 dominates. Okay. Perfect, guys. Yep. Just verify. We getting these numbers so that we can go ahead with the next part of capital structure, which is a debate and a quite interesting topic. Going to discuss the fight between two ideologies. Shall we go with the capital structure theory now, guys? Shall we go with the capital structure theory? Yeah. Feel good? Ready? Got this? Fine. Let's begin with capital structure theories, guys. Okay, so what is this capital structure theory about, or what is the debate that we are talking of? What is the debate all about? See, capital structure theory, this debate is about a very typical question in finance where we say, will the capital structure, now when I say capital structure, we mean by the debt equity mix, the proportion of debt and equity that we have. So will the capital structure, that's the debt equity mix, affect the value of the business? Is it going to affect the value of the business? So is the capital structure, the proportion between debt and equity, is it going to affect the value of the business? That's the very fundamental question. Or to put it way in a different way, we can say, if we take debt for investment in business, is it going to affect its value? Okay, is it going to affect its value? Yeah. Gumti, so the last plus assignment uploaded in ICS show blank pages. Okay, Gumti, I'll upload it once again. After today's session, I'll upload it once again. Okay. So the question was, will capital structure, that is debt equity mix, is it going to affect the value of the business? That's one point. That simply means if I'm going to take debt for investment in the business, is it going to affect the value of that entity? Or to put it in a simple way, let's say there are two identical companies. There are two identical companies, out of which one company is a geared one. Now, when I say one company is a geared one, it has taken loan, and other is a non-geared one. It means it doesn't have any loan. Will the value of their companies be different? Will the value of these companies going to be different, or is the value going to be same? We want to know. There are two identical companies from the operations perspective. From the operations perspective, we say both the companies are identical, out of which one is a geared and other is a non-geared. One of the companies is a geared company and other is a non-geared company. It means one company has taken a loan, the other company has not taken a loan. Will the value of the two companies be different, or is the value going to be same? That's the debate that we are talking about, right? Now, what sort of point that we have? There are two participants in this debate. One of them says yes. When you say yes, it means capital structure is going to affect the business, or I can say the geared company will have different value than the non-geared company. The geared company is going to have a value different than the non-geared company. That's one thing. And the other is, it says no, that is value of the company, of the geared and the ungeared company, it is going to be same. So when we say yes side, it says that value of the company or business will be affected by capital structure. That is one thing. And the other set of theories say that the value of the company or business will not be affected by the capital structure. On one side, there is a set of propositions. There is a set of financial economists who say that the entity which takes loan, it is having a different value than the entity which does not take loan. Whereas the other set of financial economists say, no, it doesn't matter whether you take loan or not. Value is going to be same for both the companies. So when these set of financial economists say yes, that the value of the company is going to be affected, when it says that yes, the value of the company is going to be affected, we say that they are talking of a relevant theory. They're talking of relevant theory. Now, what do you mean by the relevant theory? Uh, Screen sharing has stopped. Just give me a moment. Yeah. So we're talking of relevant theory and the irrelevant theory. Relevant theory talks of the point that uh, value of the company is going to be affected by the capital structure. That is, if the companies have debt equity as if one of the companies is having debt, the other company doesn't have debt, then the value is going to be different. Or I can say gearing is relevant for valuation. That's the relevant theory. And irrelevant theory says that value is not at all affected by the capital structure. Okay. So these are the two set of theories that we are going to discuss. So in relevant theory, we have net income approach, traditional approach, model with tax approach. In irrelevant theory, we have net operating income approach and approach, Modigliani Miller, right? Now, when we're talking of value of the companies will be different or it will be same, I want you to tell me, what do you understand by this term value? When I say value of business entity, what do you mean by that? What is your understanding about value? When I say that value of the two companies will be different or it will be same, I want you to have your understanding. What do you understand by the value of the company? What do you feel? What does that term value mean? Anyone? What does that term value mean, guys? Anyone? Waiting? What is the meaning of that value? When I say value of the company or value of the business will be same or it will be different. What is your understanding about value? Let's say I tell you value of Reliance Industries Limited or value of Asian Paints Limited, value of L&T Limited or value of uh, oh, value of TCS Limited. What do you mean by that? Yeah. What do you mean by that? Value? Guys, tell me. Share value, okay. Wealth maximization capability, net worth, overall cost of capital, okay. Net worth, earnings per share, value is value of equity value of debt plus preference share, financial position, brand value, market value, okay. See, when we talk of value of a company over here, understand we are talking of value of the business. So value of the business means market value of the business. It means today if I want to buy, a typical company, how much should I be paying for it? Let's say today I want to buy TCS Limited. I have got a huge amount of cash available with me and I want to buy the entire TCS company. I want to buy that entire company TCS. Or maybe for that matter, I want to buy Reliance Industries fully. I want to be the full owner of that Reliance Industries Limited. How can I be the full owner of that company? How can I be the full owner, 100% owner of that company? How can I buy it? Can I say I need to buy the equity shares of the company? will just buying equity shares of the company will make make me the 100% owner of the company? No, sir, because along with equity share capital, there are other stakeholders also in the company, which are called as the debt fund providers. So if I want to be having 100% right over the company, I will definitely buy the entire equity of the company. But also, secondly, I will be buying. Secondly, I'll be buying even the debt, or I can say I need to repay the debentures, or I need to buy the debentures of that company also, so that I'll have 100% stake. I'll have a full control over the company. I will have the full ownership of the company. So understand that whenever we say value of the firm, it is going to be value of the equity share plus value of the debt. Value of the equity share plus value of the debt. Now, in this chapter, we are following certain assumptions. I'll come to those assumptions sometimes later in just a couple of minutes. But understand that value of the firm is going to be value of equity plus value of debt. Now, one more thing over here. How do we derive the value of any asset? How do you derive the value of any asset? How do you derive the value of any asset? Yeah. How do you derive the value of any typical asset? How do you get the value of the asset? Understand, sir, value of any asset is simply present value of your future cash flows or benefit discounted at the required rate of return. Yeah. So value of any asset is going to be present value of future cash flows or benefit discounted at a required rate of return. So whatever amount of return you need, whatever future cash flows you are going to get, you are going to discount it to the present value level. You will discount the future cash flows. You will discount the future cash flows to the present level, and that's going to be the value of the asset. Any asset which doesn't have any future potential, okay, any asset which does not have any future potential is going to be a worthless. Are you going to have, I mean, if I tell you, pay 1 crore for an asset which is good for nothing in future, which is not going to provide you any benefit in future, will you assign any value to such property or any asset, any value to that asset? Are you going to provide any value to that asset? Tell me, guys. Are you going to assign any value to that asset? If the asset is not going to provide you any benefit. Sir, I bought a debenture, but on that debenture, I will not get any interest. Sir, what about redemption? No redemption. Then why the hell should I buy it, right? So any asset is always valuable only if it has future potential income for you. Any asset is going to be valuable for you only if it has future potential or you're likely to get some future cash. And of course, you need to discount it to the present value level. Okay. So as we say, value of any asset is value of the future cash flows. Value of business is also going to be in that context, that we are going to value the entire firm. And when I say entire firm, we are talking of what is the future benefit from the firm discounted at the cost of capital. Now, before we go for the formula derivation, let's have a look at certain assumptions that are valid, that are still held over here. First assumption that we say is, for this capital structure theory, is there are only two kinds of funds, either a debt or a equity. There's nothing in between. It means we are ignoring the preference share capital for these capital structure theories. Remember, these are the theories that we are discussing, and any theory is definitely subject to certain assumption and certain limitations. Take it any theory, scientific, financial, economics, accounting, any theory you take, it's always subjected to certain assumptions. And it's the beauty is you need to appreciate that theory within the walls of the assumption. So whatever we'll be discussing in today's class, it's going to be always subject to certain assumptions. Okay. So the first assumption it says is we are going to consider only two types of funds. One is a debt and other is the equity. Secondly, total assets of the firm are given. Degree of leverage can be changed by selling debt to purchase shares or selling shares to retire debt. Now, what does that mean? It means assets of the company are going to be same. What we are going to alter is the amount of equity and debt. So, for example, if you look at a balance sheet, in the balance sheet, asset of a company is 100. The capital structure includes equity and debt. Capital structure includes equity and debt. So it says you can have equity 40, debt 60. You can change this to equity 50, debt 50. You can change this to maybe equity 60, debt 40, or you can even change it to equity 100, debt 0. Right? So when we are talking of difference, when we're talking of changing the capital structure, we are just changing the equity and the debt value. Asset of the company is remaining same. Right? Right? So asset of the company should be remaining same. Only the equity and debt component should be altering with each other. That's the second assumption. Otherwise, if you change your asset, if you acquire more assets, of course, the profitability will increase. Right? So we are keeping asset constant. What is going to differ is the ratio between the debt and equity, or the value of debt and equity is going to alter. Okay. Then we say taxes not considered. Taxes are not considered. Dividend payout is going to be 100%. It means there is no retention made by the company. Now, if there is no retention, of course, there is no growth that is going to happen in the company. Then firm's total financing remains constant. That is what we have seen. That is total 100 of funds will remain same. Only the proportion between them is going to alter. Then business risk is constant over time. Right? And firm is having a perpetual life. That is, the firm is having an infinite life. That is what our assumption is. We are not looking at any firms which is going to retire or which is going to be closed in near future. Right? Let me look at the queries. Dividend payout ratio is indicating that dividend is to be paid compulsory. Yes, 100% dividend payout means we are talking of dividend to be paid compulsory. Every time whatever you earn, you pay it out to your investors. Hiral is asking degree of leverage means degree of risk. Is it correct? Hiral, degree of leverage over here means the proportion between debt and equity. Over here, degree of leverage means proportion between debt and equity. You can issue new debts, you can issue new debentures, you can buy back some equity shares, or maybe issue new equity shares. Okay. Hitesh, correct. Perpetual life means going concern. Okay, subject to these assumptions, our entire calculation is going to be there. Now, we said value of any asset is present value of future cash flows or benefits at a required rate of return. It means value of business or the value of the firm will be present value of future benefits. So, what is the future benefit that a business gives to its investors? What's the future benefit that the business gives to all its investors? Tell me. Remember from income statement, which is that number which is earned by the business entity for all its equity holders, or for not for equity holders, for all its investors. Which is that income, which is that number which is earned for all equity for all the investors? Is it EBIT? Is it PAT? Is it net profit for equity shareholders? Of course, it is the EBIT. Right? Of course, it is EBIT. So, present value of future EBIT we are going to talk of. Right? The value of the firm is going to be present value of future EBIT discounted at KO, or overall cost of capital. Right? Because KO is the overall cost of capital of the business entity. KO is the overall cost of capital of the business entity. Right? This is the return which the entity is required to earn on its investments. KO is the KO is the value or the overall cost that the entity is required to earn. Okay. So now, I hope you guys are aware about this formula. Amount is equal to P into 1 plus R raised to N. Now this amount is the future value. P is the present value. So if I want to get present value, I can get it as present value equal to this entire 1 plus r raised to n will be divided over here. Right? So that's amount upon 1 plus r raised to n. Principal is equal to amount upon 1 plus r raised to n. That's the value of p, or the present value, right? That's the present value. Perfect, guys? Yeah. So when we want to take the present value of future EBITs discounted at KO. So as we say, the entity is having a perpetual life. Dividend payout is 100%. So obviously my EBIT is not going to increase, right? So first year EBIT discounted for 1 year, that is EBIT upon 1 plus KO. Second year EBIT discounted for 2 years. Third year EBIT discounted for 3 years. And this way we take it till perpetuity. So this is how we get the present value of all future EBITs discounted at KO. Now, obviously, we are going to derive this. From this, I can take EBIT common. And inside, I can have 1 plus KO plus 1 plus KO square plus 1 plus KO cube till perpetuity. Now, can you tell me what type of series is this? 1 upon 1 plus KO plus 1 upon 1 plus KO square plus 1 upon 1 plus KO cube. What type of series is this? Is this an arithmetic progression or a geometric progression? Is this an arithmetic progression or geometric progression? Perfect, guys. This is a geometric progression, right? And I want the summation of infinite geometric progression. I want the summation of infinite geometric progression. And we know this formula. Summation of infinite geometric progression, summation till infinity is a upon 1 minus r. Right? I hope you remember this. Summation of infinite GP is a upon 1 minus r. Right? So a upon 1 minus r, if I apply over here, so this is a, and this itself is r. So every time it's getting multiplied. So it is a upon 1 minus r. So rearranging these terms, we just cancel out the things, and what we have is the value of the firm is EBIT upon KO. Value of the firm is EBIT upon KO. Yeah, so this AO is nothing but our weighted average cost of capital, overall cost of capital. Are we good with this formula, guys? Now, logically, is it fitted? Is it totally freezed into your brains that value of the firm is going to be EBIT upon KO? Of course, this is subject to the assumption that EBIT remains constant in future. Are we good with this? Value of the firm is EBIT divided by KO, which is just derived by using the geometric progression formula. Is it perfect? Shall we proceed? The first formula we have done, in which we said the value of the firm is going to be EBIT upon KO. Are we good? Shall we go for the next stage? Second formula derivation. Yep, perfect. Then, same way, if I want to talk of value of equity, what is the benefit that the equity shareholders are going to get? So since we said that there is no preference share capital in this case, since we have concluded that there is no preference share capital over here, whatever is my PAT, that itself is income for the equity shareholders. The benefit that equity shareholders are having is going to be profit after tax, right? Yeah. So that's going to be profit after tax. So it's going to be PAT upon, obviously now for equity shareholders, I need to discount it using K. So PAT upon 1 plus K, PAT upon 1 plus K square, PAT upon 1 plus K, it will go again like this. And that again forms a GP, and that will get and derive, that is formed derived as a PAT upon K. Same way, value of debt will be like the future interest that discounted by cost of debt. That will give us the value of debt as interest upon KD. Okay. So these three are the formulae. Let me see if there are any queries. Proceed. Okay, sir. Back. Okay. AO before tax for debenture also. Mansha, we have said an assumption over here that no tax is applicable. Now, when tax assumption is removed, what is the implication that we'll see in the next course of next few minutes? How can be business risk constant over time? Smita, uh, that's the assumption that we have. Smita is asking how can the business risk be constant over time? Uh, business risk is constant. It's an assumption basically. Because unless and until you say that business risk is constant, uh, you will not be able to actually compare whether capital structure is going to have the implication on the value or not. Because business risk can also have an implication on the value of the firm, and therefore we assume business risk is constant only due to financial risk. What is the implication? What is the implication on the value of the firm? Okay. Whether S stand for shares, yes, you can say value of the share. Perfect. Fine. So that's the three formula. And then we have another fourth formula as value of equity plus value of debt is equal to value of the firm. Value of equity plus value of debt is equal to value of the firm. Okay, so we need to understand these four formulae for further course of discussion. I hope this is clear to everyone. Is this fine with everyone? Value of firm, value of equity, value of debt, and obviously the value of firm, another formula, which is value of equity plus value of debt. Because understand the firm in totality is what? It's a net effect. It's a cumulative effect of equity and debenture, right? Okay. Let's go ahead with the first approach. Before that, any queries? So Siddharth is asking, so in practical life, these assumptions might be simply valid and there's a bit impractical, right, sir? It's a theoretical aspect. So whenever you're learning anything in theory, you always keep something constant or you always have certain assumption. Like in demand theory also, in supply theory, theory of supply, theory of demand, law of diminishing marginal utility, you had certain assumptions, right? In law of demand, you said that as the price increase, the demand will fall. That was also subject to certain exceptions and assumptions. So that same thing is applied over here. Instead of PAT, we should take profit available for equity shareholders. Hiral, we are considering PAT itself because profit available for equity shareholders is same as PAT over here due to the assumption that no preference shares are included over here. Fine? Yep. Okay. Now, in this capital structure, we are going to discuss the first theory, which is the relevant theory or theory of relevance. Yeah. So in our discussion, first theory that we are going to take up in the relevant theory, that's the net income approach. We're going to take up the net income approach. Net income approach was relevant theory. What was relevant theory? So net income approach was concluding that value of two business entities is going to be different due to capital structure. It means if one company is having debt and the other company is having no debt, then they are going to be different values, right? Now, understand the way in which this theory is derived or these explanations are given, or just look at the the creativity in the justification provided by the financial economists when they say that they're talking of some net income or net operating income. Okay. Now, the first and foremost thing that they say Remember, net income approach is a relevant theory. It means value will differ according to the capital structure. We say cost of debt is less than cost of equity. Is this true or false, guys? The first statement put up in the net income approach is that cost of debt is less than cost of equity. Is this right or wrong? Is this right or wrong? Cost of debt is less than cost of equity. Tell me, is this true or false? Cost of debt is less than cost of equity. Yep. Tell me, guys, is the cost of debt less than cost of equity? True or not? True or false? Right? Yes, it's true, sir. Cost of debt is less than cost of equity. Always, your cost of equity is always going to be higher. Cost of debt is always going to be lower. Right? Pooja is asking if there is no tax as per the assumption, then why are we taking? Basically, Pooja, over here, PAT and your PBT, profit before tax, is going to be the same figure. Okay, true. Yeah, cost of debt is less than cost of equity always, guys. Remember, in finance, cost of debt and cost of equity is going to be having this relation. That's cost of debt is going to be smaller than cost of equity. Right? I can give you a very simple example to understand this. Suppose you are financing your CA course by way of bank loan. By way of bank loan, right? It's a project, right? It's an educational project that you are running. So entire CA course is let's say funded by a bank loan. Tell me what will be the expectation of bank? How much return would bank expect from you? How much return would bank expect from you? You're taking a loan from bank. Bank might be expecting some return from you. That is a rate of interest. So bank loan will be at a maybe at, let's say, 15%. 15% would be the rate of interest that the bank would be expecting on this loan, right? So let's say your CA course is funded by a bank loan at the rate of 15%. The bank expects that every 100 rupees that it is providing, the bank should get 15% in return, right? Now, if this same CA course, if it is funded by your own parents, how much return would they be expecting? Tell me. How much return would they be expecting on their funds? Will they be expecting that you will return back them the 15% interest? Is that the expectation of your parents? Because parents are investing in your education, it means it's an equity investment, owned investment, right? Are your parents expecting 15% return? Then can I say definitely more than 15%? If you consider it financially, they might be considering 200, 300% return also. Right? They would expect that you qualify CA, you get into a good corporate career or maybe into a practice and start having a stable life. Right? So their expectation from your education project is very high as compared to bank loan. So that's the whole point I said it, that debt is always having a fixed return, but that is lower than the return that the equity shareholders are expecting. Right? So the same fundamental goes even with any business entity, because when you invest in any company equity shares, you don't expect the company to be paying you meager 10-15%. You expect the company to be growing in long term, and that cost is very high. Okay, so the first point is true, sir, as stated by the net income approach, that the cost of debt is less than cost of equity. The first point is correct. Cost of debt is less than cost of equity. Now, the second point, it says, if the weightage of debt increases, overall cost will reduce. We say if the weightage of debt increases, KO is going to reduce. It means this theory says if you take more debt, then the overall cost of capital is going to reduce. So KO is overall cost of capital. And we know we calculate overall cost of capital like this, right? We have weightage of debt, we have cost of debt, weightage of equity, cost of equity. So we multiply weightage with the cost. So that's weightage of debt into cost of debt, weightage of equity into cost of equity. So overall cost of capital will work out to be what? Weightage of debt into cost of debt plus weightage of equity into cost of equity. Right? So that's what we say over here. Formula I've taken it as KO is weightage of debt into cost of debt plus weightage of equity into cost of equity. Now, let us consider multiple scenarios over here. In the first case, let's say we have a company with equity capital fully 10,000. Equity capital fully 10,000. So weightage of equity is 1, weightage of debt is 0. Weightage of equity is 1, weightage of debt is 0. Okay. Cost of debt and cost of equity. Cost of debt and cost of equity, let's say it is 10% and 15%. As we have stated, cost of debt is going to be lower than cost of equity, so 10%, 15%. What will be overall cost of capital? 10% into 0 plus 15% into 1. So 10% into 0 and 15% into 1. That will give us the overall cost of capital as 15%. Second scenario, we say, let's say company buys back some of its equity shares by taking loan. So let's say company has borrowed some money to buy back equity shares. The company has borrowed, let's say 1,000, and of course the equity value or equity shares of 1,000 are bought back. We have equity share capital outstanding is 9,000. Now the weightage becomes 0.1 and 0.9. So taking the cost of debt as 10% and 15%, right? When taking the debt as 10%, 15%, if you take again a weighted average number, over here you'll get this as 14.5. Now if you add more and more debt, that is you're taking more and more amount of debt into your business, what we observe is that overall cost of capital KO is falling. Right? Overall cost of capital of the firm is falling. So as you increase your debt, as you increase the weightage of debt, overall cost of capital is falling. So if weightage of debt increases, KO will reduce. If the weightage of debt increases, overall cost of capital is going to be reduced. Okay. So the second point is also proved by mathematical expressions. Now the third point and the final point which they say is, they say when the KO reduces, as the KO reduces, overall cost of capital as the KO reduces, value of the firm is going to increase. So if your KO reduces, value of the firm will increase. So let's assume an EBIT of 3,000. When our KO was 15%, the value of the firm would be like EBIT upon KO. Formula that we have already derived. Value of the firm is EBIT upon KO. We have derived this anyways by the geometric progression thing. We get 3,000 divided by 15%, 3,000 divided by 14.5%, 3,000 divided by 12.5%, 3,000 divided by 10.5%. So what we observe is as the overall cost of capital reduces, value of the firm increases. Right? So that's the explanation or the justification given by the net income approach. Is it logically derived by you guys? Yeah. Let me look at the queries. Explain the long term. Okay, then explain the second point once again. Okay. Shia, see. Second point says as the value of debt increases, KO will reduce. So initially we had a fully equity company with 0 weightage of debt and 1 as a weightage of equity. So cost of debt is assumed as 10%, cost of equity is anyways higher at 15%. So we get overall cost of capital as KO as 15%. Now, when you buy back some of the equity shares and replace them with debt, it means you borrow money and with that money you buy back equity shares. So 1,000 you bought back. So your weightage becomes 0.1 for weightage of debt, 0.9 becomes the weightage of equity. And then again, you multiply this to get the overall cost of capital. So as we observe over here that as more and more debt proportion is increasing, the overall cost of capital is reducing. Yep. Is it clear, Shia? Yeah. Okay. So if you look at the chart as to what is happening, the understand over here, leverage means proportion of debt. Here, leverage means proportion of debt, that is weightage of debt. So we say as the proportion of debt increase, the weighted average cost of capital keeps on reducing. And as we say, as the weighted average cost of capital keeps on reducing, the value of the firm will increase. So in the first case, when the company had only equity shares, it would have a valuation of 20,000. But in the fourth case, when the company is having only equity as 1,000 and debt as 9,000, then the overall value of the company will be 28,571. Then the overall cost of capital, then the value of the firm will be 28,571. Okay, 28,571 is the value of the firm. So that is simply stating that company having debt in the capital structure will have a greater value as compared to no debt company. That is, optimal capital structure would be the one in which your weightage of debt is almost tending to 100 or maybe like 99.999%, and weightage of equity is, you cannot have weightage of debt, equity as 0, because if there is no equity in the company, then the company doesn't exist at all, right? Because there's no equity share capital. If there is no owned funds in the company, it means the company is not at all existing. Okay, guys. So that's the explanation for net income approach. I hope this is crystal clear to everyone. The net income approach clear? Perfect. Okay. Now, if I ask you that in this entire explanation, there is something which is shortcoming, or there is one very important or crucial point which was overlooked in this theory. Can you tell me what is that point which was overlooked, or which is, a mistake in this typical model? Can you tell me what is that typical, mistake in this model? A very crucial and important point is missing in this explanation, because, or I can say that's a shortcoming of this net income approach, based on which we have the net approach, based on which we have the next theory that we are going to discuss. What is the shortcoming in this? Business risk is constant, no. Ideal debt equity ratio, no, not ideal equity ratio. Not considering profit, no. Anyways, profit EBIT is a constant term, no. The important point that is missing over here is, tell me, if you take more and more debt, will you as an equity shareholder be still expecting 15% return? Are you going to expect same 15% return irrespective of the amount of debt that the company takes? We mean to say that when the company is having no debt, you expect, or the equity shareholders require 15% return. And when the company is having 9,000 debt, still the equity shareholders will expect 9%, they will expect the 15% return? Of course not. Equity shareholders will start expecting a higher return because of the risk in it. Because if the company is taking more and more debt, the company is undertaking more risk. So as an equity shareholder, I should get compensated for that higher risk. I should get compensated for that higher risk. And that's the shortcoming of this theory, guys. This theory assumes that your cost of equity is constant, but it's not constant every time. Cost of equity will change due to the higher risk involved in it. And that's where we have another approach called as net operating income approach. We have this net operating income approach. Now, what does this net operating income approach talk about? See, this approach says, first point is cost of debt is less than cost of equity, which is very much fine, which is perfectly correct. Cost of debt less than cost of equity, it's all okay. Secondly, it says as weightage of debt increases, KO is going to reduce. That is also what we have observed, that as the weightage of debt increases, KO will reduce. But that was under an assumption that KE is remaining constant. For whatever level of debt you take, KE remains same. That was the assumption that we had. Right? So that was an assumption over here. But then we start realize that, sir, KE is not going to be a constant term. KE is not going to be a constant term. So what will happen is, as the weightage of debt increases, risk for the equity shareholder increases, and therefore overall cost of capital will also start increasing due to KE being increased. So, as the weightage of debt increases, equity shareholders will perceive a higher risk. Equity shareholders will say there is a higher risk involved in it. And when we say that there is a greater risk involved in it, we say that as an equity shareholder, I need to get a higher return. Now, when I want a higher return, of course, my KE will also start increasing. Now, what will happen if KE starts increasing? So, overall cost of capital will also increase, because overall cost of capital is ultimately derived from KE also. So on one side, there is a downward pressure on KO due to greater weightage of debt. On the other side, there is an upward pressure on KO due to increased KE. And what will be the net effect of both of them? So there is a pressure on KO that is pulling it upside, and that's also pulling downside. Because of that pressure upside as well as downside, it will remain constant. The KO is going to remain constant over here. What we say is KO is being pulled down due to higher weightage of debt. KO is being pulled up due to increase in K due to perceived higher risk. Overall, what is going to happen? It will remain a constant figure. Overall, it will remain a constant figure. So what we can say is that with this example, suppose originally we have 1,000 debt and 9,000 equity. 1,000 debt and 9,000 equity. So weightage of debt is 0.1, weightage of equity is 0.9. Weightage of debt is 0.1, weightage of equity is 0.9. KD is, let's say, 10%, K was, let's say, 15%. So overall cost of capital was working out to be 14.5%. Now, as the debt increases, as the debt proportion increases, 0.5, 0.5. Obviously, KD remains constant 10%, but my equity shareholders start expecting a higher return. Because when you're taking more debt, equity shareholders are not going to be satisfied with 15% return. They will need a higher return. So how much higher return? They will need probably 19%. So 10% and 19%, the overall cost of capital, the weighted average is going to be 14.5%. Overall cost of capital is going to be 14.5%. And if you take even more debt, equity shareholders are going to be expecting a very high return, because having 9,000 debt and only 1,000 equity, it's a very risky scenario, sir. And therefore, equity shareholders will start expecting a higher return. And that's where KO is going to be 14.5% constant. Because see, on this KO, there is upward pressure as well as downward pressure. Both way it is getting pulled. It is getting pulled downward. It is getting pulled downward because debt proportion is increasing, getting pulled upward because of the higher Q. Okay, so overall cost of capital remains constant because of this. Okay, Shreya is asking, sir, why cost of debt is constant? Cost of debt is constant generally, or I can say when you take a loan from bank, you take a 1 rupee loan or a 10 rupee loan. It's a constant figure you get, right? Because for the risk for the generally risk for the debenture holders remains same, right? But Shreya, I want to highlight over here that assuming that cost of debt to be constant is also wrong, because understand, when you take a loan from bank, you take a loan of 10 lakh or you take a loan of 1 crore, you'll be charged different rate of interest, because higher debt will also involve higher risk for the bank. So bank will always say that if you want to take a greater amount of loan, you need to pay a bit of higher rate of interest, right? So what we say is, as the KO is constant, value of the company will also remain constant. And if you look at the chart, as the leverage of the proportional debt increases, KD is constant, KO is increasing, and overall cost of capital remains constant. So what can we say over here? Since the KO is constant, value of the firm will be also constant. It means whether you take loan or whether you don't take any loan, value of the entity is going to be remaining same. Or I can say, in conclusion, we can state that value of business is not affected by capital structure. Value of the business is not affected by capital structure. Any capital structure you take, whether you take debt or you don't take debt, overall cost of capital is constant. So the value of the firm is also going to remain constant. That's the net operating income approach. Okay. There's a net operating income approach. Now, over here, as Shreya highlighted, she said, sir, how can we assume that cost of debt to be constant? Of course, we cannot assume that the cost of debt to be constant, irrespective of whatever loan you take. And that's where the shortcoming of this approach lies. This approach is having that shortcoming, or that, that this approach is having a typical limitation, that you assume that cost of debt to be same. In practical life, it's not going to be, because if you take more loan, bank is not going to charge you the same rate of interest. If you take a loan of 1 lakh or you take a loan of 1 crore, the rate of interest that is charged to you, it won't be the same, right? So now to challenge this or to correct this, we have the next approach, which is a traditional approach. Look at this, guys. Traditional approach. Now, the traditional approach, it takes side of both net income as well as net operating income. What it says is, the weightage of debt that you take, or the proportion of debt that you take, can be divided into 3 phases. It can be divided into 3 phases. Phase 1 talks of some small amount of debt that you're going to take for day-to-day operations. Very small amount of debt. So it's like a 10 crore valuation company taking a loan of 1 lakh or 2 lakh, right? So small amount of debt that will not affect the cost of debt or cost of equity, right? So in this first phase, KE remains constant and KD also remains constant, because a very small amount of loan you are taking, like if you take 1 lakh loan or 2 lakh loan, the rate of interest will be almost same. If you say that instead of 1 lakh, if I want to take 10 crore loan, the rate of interest will differ. Now, if you even borrow like 1 lakh or 2 lakh for your day-to-day operations, your equity shareholders will understand you that this is a regular thing. This is a normal thing that is being happening. And it's not that very risk, it's not leading to any substantial additional risk. And for that purpose, KE remains constant. KD also remains constant. But yes, due to increased weightage of debt, KO falls. With increased weightage of debt, KO falls. Okay. So small amount of debt will not be affecting your KD or KE. KO will witness a fall. And as KO falls, we have seen that value of the firm will increase. And can you tell me this first phase is similar to which approach? Net income approach or a net operating income approach? The first phase of traditional approach, is it equal to net income approach or net operating income approach? Tell me, guys. First phase is equal to which approach? First phase is equal to which approach? Net income approach or net operating income approach? Yep. Yep. Tell me, guys. Net income approach. Perfect. So first phase is almost on the same lines as the net income approach was talking of. So if you look at just the graph of this first phase, you'll find that it's the same as net income approach. Then we move to the second phase. Now in the second phase, we say, so beyond this first phase, if you take more amount of debt, equity shareholders will start taking a backseat. Now they will say that now enough is enough. This much loan is tolerable. Beyond this, if you take a loan, it means you are taking more risk. It means you're taking more risk. So if you're taking more risk, equity shareholders will start asking for higher return, or equity shareholders will start asking for a greater return. Now, as the equity shareholders starts increasing, KE will start increasing due to higher debt. KE will start increasing due to higher debt. And as KE starts increasing, sir, on this KO, there is a downward pressure by low KD and higher upward pressure by high KE. It will become constant. And this second phase is identical to the net operating income approach. Second phase is the identical to net operating income approach. Now, beyond a particular point of time, beyond a particular level of debt, bank is not going to provide you loan at the same rate that it was earlier providing. So bank was providing loan at the rate of 10%, 10%. But after a point of time, bank will say it will be 12%, 13%, 14, 15, 16, depending on how much loan you take. So due to higher amount of loan, bankers will start asking for higher rate of interest. And as the bankers start asking for higher rate of interest, equity shareholders are anyways asking for higher rate of interest. What will happen to our KO? So KO will also start increasing because KD is increasing. KE was anyways already increasing, and that will lead to higher approach. So KD and KE both increases. Both KD and KE increase. KO will also start increasing, and the value of the business will start decreasing. So can you tell me, guys, where is our KO lowest? Is it in phase 1, phase 2, or phase 3? Where is the KO lowest? Where is the KO lowest? Is it in the phase 1, or is it in the phase 2, or is it in the phase 3? Where do you find that the KO is lowest? Where do you find that the KO is lowest, guys? Phase 2, perfect. Phase 2. In phase 2, you find the KO to be lowest. It means it's the optimal capital structure. The phase 2 is the optimal capital structure because at this stage, you find that the overall cost of capital is lowest. And also at this point, value of the firm will be highest. After phase 2, understand taking more and more debt will lead to dilution, or it will lead to reduction in the value of the firm. KO is lowest in phase 2, guys. Okay. Is this clear? The traditional approach, the 3-phase capital structure theory. Are we good with this? Are we perfectly fine with this? All the 3 approaches are clear. Net income, net operating income, and traditional theory. Yeah, great. Hiral, KO is falling, but at the lowest you will find it in phase 2. At the lowest it is fine, you'll find that the KO is lowest. So in phase 1 it is falling, in phase 1 it stays at that lowest level, and then in phase 3 it starts increasing. Okay, fine, guys. Now let us get started with some problems, some practical problems. Let's take example or question number 1 for that case. Take question number 1 to apply this typical formula. Okay, see. Lakshmi Limited is expecting an annual earnings before the payment of interest and tax of rupees 2 lakhs. The company in its capital structure has 8 lakhs in 10% debentures. Cost of equity or capitalization rate is 12.5%. You are required to calculate the value of the firm according to net income approach. Also compute the overall cost of capital. Okay. Yeah. Here, phase 2, it is constant. Phase 2, it is not falling, but it has reduced to the lowest possible level in phase 2. So it is staying at that lowest level in phase 2. So in phase 1, it is reducing. After reaching this point, it is staying constant over here. Constantly low. And then it starts increasing in phase 3. Yeah. First question. Expected annual earnings before payment of interest and tax is 2 lakh. What is this 2 lakh, guys? Earnings before interest and tax. Earnings before interest and tax. Can I say that's EBIT? Right? We have EBIT of 2 lakh. EBIT of 2 lakh. Company in its capital structure has 8 lakh in 10% debentures. Okay. So what is this 8 lakh in 10% debentures? We have 8 lakh as the value of debt. Cost of equity or capitalization rate is 12.5%. Now they say even the 10% debentures, the cost of debt is 10% and capitalization rate or cost of equity is 12.5%. What we want is we want to compute the value of the firm according to NI approach, also compute the overall cost of capital. Now, to compute the value of the firm, we need to divide EBIT by KO, or we can simply say, so value of the firm is value of debt plus value of equity. So we'll start with EBIT level. We have a EBIT of 2 lakh. Interest is going to be 10% of 8 lakh, which is 80,000. And PAT was 1 lakh 20,000. PAT or PBT is 1 lakh 20,000. I can get the value of the equity, right? Value of equity or value of the shares by this formula, PAT upon KE. So PAT is 1 lakh, profit after tax is 1 lakh 20,000 divided by overall the cost of equity is 12.5%. That translates to 9 lakh 60,000. To that, we add the value of debt, which is 8 lakh, and the value of firm is 17 lakh 60,000. Value of the firm is 17 lakh 60,000. So the first part, overall value of the firm is done. Value of the firm is 17 lakh 60,000. Now we have the value of firm formula also as EBIT upon KO, earnings before interest and tax upon KO. So we have earnings before interest and tax is 2 lakh upon KO, which is not known. but value of the firm is 17,60,000. So overall cost of capital is going to be 2 lakh divided by 17,60,000. That translates to 11.36%. We got overall cost of capital as 11.36%. Fine. Let's do question number 2 now. Let's solve question number 2. Which says, assume in the illustration given above, the firm decides to raise 2 lakh by issue of debentures and to issue proceeds there to redeem the equity shares. So the company is going to raise debt by way of 2 lakhs issue of debentures, and that will be used to buy back the equity shares. You are required to calculate the value of the firm using NI approach, also compute the overall cost of capital. Now, first and foremost that we need to look at over here is what will be the value of debt now? Value of debt, because we are anyways going to taking the first question as a reference. What will be the value of debt? So it was earlier 8 lakh. On that, we are going to add 2 lakh as the additional debenture that is raised. So that translates to 10 lakh. Right? Cost of debt, same 10%. Cost of equity, same 12.5%. So how can you assume it remaining to be same? Because they are saying net income approach. So we get a EBIT. Which is still remaining as 2 lakh. Now let's prepare the income statement. EBIT of 2 lakh. From that we reduce the interest, which is 1 lakh. We have profit before tax as 1 lakh. Value of equity or value of shares is going to be 1 lakh divided by the 12.5%. Right? So that translates to 8 lakh. And we have the value of debt or the debentures to be 10 lakh. And what we observe is that value of the firm becomes 18 lakh. Now, when the value of the firm is 18 lakh, what will be overall cost of capital? That's going to be 18 lakh. Overall cost of capital, we have seen the earlier case that overall cost of capital will be EBIT upon value of the firm. Just the formula is rearranged. So EBIT of 2 lakh upon 18 lakh. Overall cost of capital that we observe is 11.11%. Okay, guys. This question is already shared. I think I have shared this question file with you guys. I shared this question file. If it's not, I'll share it in the break also. Now, let's look at question number 3 before we go for a break. Question number 3. Modern Limited is expecting an earnings before interest and tax of 4 lakh and belongs to a risk class of 10%. Okay, so Modern Limited is expecting an earnings before interest and tax of 4 lakh and belongs to a risk class of 10%. You are required to find out the value of the firm and the cost of equity capital if it employs 8% debt to the extent of 20%, 35%, or 50% of the total financial requirement of rupees 20 lakhs. Yeah. Why we took 1 lakh in value of equity? We are buyback equity shares. 1 lakh, where have I taken 1 lakh? I've taken this PBT of 1 lakh. Smita, taken this 1 lakh PBT. Value of equity is PBT or PAT divided by K, right? So that's the point of it. Okay. So question 3, it's expecting an EBIT of 4 lakh and belongs to a risk class of 10%. They're required to find out the value of the firm and cost of risk class of 10%. What do you mean by this risk class of 10%? Is it cost of equity or cost of overall cost of capital? Is it KO or KE? Of course, sir, KO, because the question is asking us to calculate the cost of equity. If it employs 8% debt to the extent of 20%, 35%, or 50% of the total financial requirement of 20 lakh. Okay, see. In question 3, KO is given as 10%. We need to know, so value of equity is PAT upon K. That simply implies K will be PAT upon value of equity. Okay. So under different proportions, we are going to get the values. The various scenarios that they have given is 20, 35, and 50 of the financial requirement. So weightage of debt, in first case, we say it is 20%. So weightage of equity will be but obvious 80%. If weightage of debt, you take it as 35%. Weightage of equity will be 65%. Weightage of debt, if you take 50%, weightage of equity will be 50%. For that, they have also given us a KD amount, which is 8%. 8% debt. 8% debt is given. Overall cost of capital also known to us as 10%. EBIT is also given to us in the question as 4 lakh. Now, what will be the value of the firm? Sir, value of the firm, we know EBIT, we know KO. We know EBIT, we know overall cost of capital. So EBIT upon KO will give you value of the firm. Because if you're saying overall cost of capital is just 10%, every time the value of the firm is going to be 40 lakh. And what's the value of the debt? They say value of debt will be 20 lakh is the fund that you need to raise. And out of that, you are saying that 20% will be debt or 35% will be debt or 50% will be debt. So value of the firm, we have got it. Value of debt will be 20 lakh into weightage of debt. 20 lakh into weightage of debt, which will be 4 lakh. 20 lakh into weightage of debt, 7 lakh. 20 lakh into weightage of debt, 10 lakh. So weightage of debt is 4 lakh, 7 lakh, and 10 lakh. Okay. Value of debt, we get it as 4, 7, and 10. Then we can get the value of equity. So if the overall value of the firm is 40 lakh, value of equity will be value of firm minus value of debt, which is 36 lakh, 33, and 30 lakh. Then we can get the profit after tax figure. Profit after tax will be simply from EBIT, you reduce the interest part. Anyways, no tax is there. Your profit after tax, profit before tax is just one and the same. So from EBIT of 4 lakh, you remove the interest that you're paying on the loan amount. So 4 lakh minus 4 lakh into 8%, 4 lakh minus 7 lakh into 8%, and 4 lakh minus 10 lakh into 8%. So these are the profit after tax figures. Yeah. So KE, cost of equity, is PAT upon value of the equity. That's what we have derived. So we have got a PAT, we have got a value of equity, divide it, and you'll get these figures of overall cost of equity. Okay. The third question clear, guys? Is it perfectly fine, guys? Third question. Yep, fine. So with that, we'll just take a break right now. Let's take a break of 10 minutes. After that, we'll continue with the remaining questions. Let's take a break of 10 minutes, guys. Okay, guys, welcome back after the break. I've uploaded the question file once again, guys. Uploaded this question file. You can have a look at it. Okay, now let's go for the next model. I'll be sharing this entire PDF with you, which has got the other questions solutions also. The next model is about the same net operating income approach. But here in this net operating income approach, we are removing that assumption of no tax. So we're looking at a scenario in which we are definitely discussing about net operating income, but with taxes. Or this is also called as model with taxes. Hiral is asking, how do you get value of equity in question 3? Hiral, value of equity in question 3 is value of firm minus value of debt. Overall value of the firm is 40 lakh. The value of debt is 4 lakh. So difference will be the 36 lakh is value of equity. Okay. Now, coming back to this. Net operating income approach with taxes or model. Generally what happens is, in case of there is no tax, in case of zero taxes, value of the levered firm will be same as value of unlevered firm, right? Value, be it levered firm, be it unlevered firm. The net operating income with taxes, this approach says that both the companies will have same value, irrespective whether you have loan or whether you don't have any loan. However, said that if you bring taxes into the picture, then the levered firm value will not be same as unlevered firm. Rather, levered firm value will be unlevered firm plus the value of debt. The levered firm value will be unlevered firm plus the value of debt into taxes. Now let's derive this logically as to how does this happen. In case of a levered firm and in case of an unlevered firm, can you tell me, out of these two firms, which of the firms will be able to have tax saving due to interest payment? Which of these two firms will have tax savings due to interest payment? Tell me, is the levered firm going to have the tax saving or is the unlevered firm going to have a tax saving? Tax savings due to interest payment. Which of these two firms will have tax savings due to interest payment? Is it levered or unlevered? Is it the levered firm or is it the unlevered firm? Of course, it's a levered firm, right? So, in levered firm, there will be additional cash inflow due to tax savings on interest expense. Due to tax savings on interest expense. So now, suppose if I tell you, interest payable is 1 lakh. Tax rate is, let's say, 30%. Okay, interest payable is 1 lakh. Tax rate is, let's say, 30%. Can you tell me what will be the amount of tax savings? What will be the amount of tax savings? What will be the amount of tax savings? If interest is 1 lakh, tax rate is 30%. What will be the amount of tax savings? Yep, tell me. Amount of tax saving is going to be how much? If you're paying interest of 1 lakh and the tax bracket for you is 30%, what is the amount of tax saving? Of course, 30,000, right? So how do we get this 30,000? That's 1 lakh multiplied by 30%. 1 lakh multiplied by 30%. So interest of 1 lakh, tax rate is 30% and tax savings is 30,000. So 1 lakh into 30%. Right? Okay. So basically, the amount of tax saving will be the interest into tax rate. The value of levered form is unlevered form plus present value of future tax savings. So a levered form will have that additional advantage of having greater cash inflow, greater benefit due to tax saving. So first year, it is going to have a tax saving of interest into tax rate. Second year, it will again have a tax saving of interest into tax rate. Third year also, it is going to have a interest into tax rate. Right? So this will happen till perpetuity. This will happen till perpetuity. So sir, unlevered form plus this additional tax savings present value. So first year tax saving discounted by 1 year, second year tax saving discounted by discounted by 2 years, third year divided by 3 years. So in this way, we can say interest into tax saving I can take common outside, and inside I have 1 plus KD, 1 upon 1 plus KD, 1 upon 1 plus KD square till perpetuity. Again, can I say this is a geometric progression going till perpetuity? So A upon 1 minus R. So this turns out to be interest into tax upon into 1 upon KD. Now, interest upon KD. Tell me, what is the formula for, what's the answer for this? Interest upon KD. Can I say interest upon KD was value of debt? Interest upon KD was value of debt, and this tax rate remains as it is. That's how we are going to derive the formula of value of levered form will be equal to value of unlevered plus value of debt into tax rate. Value of levered form is value of unlevered plus value of debt into tax rate. Is it clear? Is this formula perfectly fine? Levered form is going to be unlevered plus the value of debt into tax rate. Okay. Now, of course, when I want to say what should be the value of unlevered form, so since it is an unlevered, it doesn't have any debt. So that will be same as value of equity. That's going to be PAT upon KE. PAT upon KE. So PAT is basically PBT into 1 minus T. Because PAT you would have got it as PBT minus PBT into tax rate. So you take PBT common. So that becomes PBT into 1 minus T upon KO. Right? Because for unlevered form, KE and KO is going to be one and the same because there is no debt. Or I can say unlevered form, I can arrive at unlevered form value also as EBIT into 1 minus T upon KO. Because remember, since it's an unlevered form, your profit before tax will be same as EBIT. Right? So for unlevered form, value will be derived as EBIT 1 minus T upon KO. For unlevered form, we need to remember KO will be same as KE. PAT will be, of course, EBIT minus interest into 1 minus T. So PAT, you can say it is EBIT 1 minus T over here. Okay. Another set of formula that we need to remember over here is cost of equity of levered will be cost of equity of unlevered plus cost of equity of unlevered minus cost of debt into debt upon debt plus equity. Okay. So you can also say, sir, overall cost of capital of levered will be cost of equity of unlevered into 1 minus tax rate into D upon D plus E. Or these are DRE what? Debt of value of debt and value of equity. Okay, these two set of formula you need to remember. Now, I'm not going to derive this formula because we will be again require a lot of time to derive this formula. So I'm not deriving this, but then yes, you need to remember this formula. Cost of equity for levered will be cost of equity of unlevered plus cost of equity of unlevered minus cost of debt upon debt to overall capital adjustment. So the point that we are deriving right now is value of levered form will be value of unlevered plus value of debt into equity. So for an unlevered firm, value of unlevered firm will be EBIT 1 minus T upon KO, and KE of levered and overall cost of levered are these formula. Okay. Now let's apply this with the help of question number 7, guys. Question number 7. Yes. Question 7. RES Limited is an all equity financed company with a market value of 25 lakh and cost of equity of 21%. The company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt of the same amount. Rate of tax may be taken as 30%. After capital restructuring and applying model with taxes, you are required to calculate market value of RES Limited, cost of equity, weighted average cost of capital, and comment on it. So we are going to do this calculation after capital restructure. Okay, just read the question once again, guys. Just give you a minute. Go through the question once again, and then we'll start solving it. Yep. Fine. Okay. So let's have a look at it. Based on the initial numbers, whatever is stated in the question, we're just writing it down over here. We have been given it's a all equity. So it's all equity. So that's an unlevered entity. Unlevered entity is having a value of 25 lakh. Cost of equity is 21%. Value of debt is nil. Obviously, the value of firm will be 25 lakhs. Cost of equity is 21%. Cost of debt is also nil. Then we are talking of, we are evaluating that if you want to buy back equity shares worth 5 lakh, so we are going to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt of the same amount. It means we are going to raise 5 lakh debt at the rate of 15% interest. So what will the impact on my market value? That's what we have to evaluate. Okay. So the all equity financed, we have all these figures. Now I have to get a lot of other things to be calculated over here. So whatever I have written, that's stated in the question itself. Right. Now to do further calculation, we need to have some sort of discussion over here. And that is going to be, to fill up the further part, I need EBIT, interest, and all these figures in the unlevered case, and also taking it over to the levered. Now, how do I get this calculations over here? So first up, I can definitely apply the PAT thing, because value of equity, we know it is PAT upon K. Value of equity is PAT upon K, right? We know the value of equity stands as 25 lakh. Value of equity is 25 lakh is equal to PAT upon K is 21%. PAT is 25 lakh into 21%. So that comes out to be 5,25,000, guys. We got the PAT. PAT is 5,25,000, and we can just take a upward 5,25,000. Now, if I have a PAT of 5,25,000, can I calculate PBT and tax rate? Yes, definitely, sir. I can take the PBT as 100, so this is 30, so PAT is 70. 5,25,000 is 70%, so tax rate is going to be 2,25,000, and profit before tax will be definitely by going backward calculation. That will be 7,50,000. Since there is no interest, the EBIT that the company is making is 7,50,000. Right now, that's the first step that we have done. So whatever is marked in green, we are doing it in the first stage. Okay. Now take this 7,50,000 or RES Limited and give me the PAT figure, guys. Give me the PAT figure. Give me the PAT figure. Give me the profit after tax figure. Yep. Give me the profit after tax figure for this. See, we are contemplating taking a loan of how much? 5 lakh. So on this 5 lakh, interest is payable at the rate of 15%. 5 lakh into 15%. 5 lakh into 15%. That's 75,000. And when we divide it, we say it's 6,75,000. Tax rate 30%, that will be 2,02,500. And PAT is 4,72,500. Okay. PAT is 4,72,500. That's the PAT figure which we have got. If you have got it, yes. Many of you have 4,72,500. Many of you have got it correct. Now, once this is done, the next thing that we have to calculate is the other things which we have. So, what will be the value of equity? We have got a PAT of this, PAT of 4,72,000. So, PAT of 4,72,000. I need to have the cost of equity. I need to have the value of the equity also. Now, first and foremost that we need to write up over here is this 25 lakh need to be translated to the value of levered form. So base the value of levered form be equal to value of unlevered plus debt multiplied by tax rate. Value of levered form will be value of unlevered plus debt multiplied by tax rate. Value of unlevered is 25 lakh plus 5 lakh into 0.3 debt into tax rate. So this becomes 26,50,000 as the value of the firm. Now, if we say that value of the firm is 26,50,000, I will get this to value of equity, which is 21,60,000. Because remember, 21 lakh 50, sorry, 21 lakh 50,000. Because 26 lakh 50 is actually summation of value of equity and value of debt. Right? So value of equity 21 lakh 50, value of debt is 5 lakh, value of firm is 26 lakh 50,000. Cost of equity is 21%, and over here for the levered entity, we can get this cost of equity by simply applying the formula of PAT of 4,72,500 upon 21,50,000. That's value of equity, which is like PAT upon value of equity. So cost of equity, you'll find that it is 21.98%. Cost of debt, since the rate of interest is 15%, I need to make it a after-tax cost of debt as 10.5. That's what we have got. We have got the market value of RES, we have got the cost of equity. Now, weighted average cost of capital. Weighted average cost of capital in this case, we will get the weighted average by, let me just do one thing. This is what we have done second, and then finally the pink stuff is third. Then the weighted average cost of capital, or WACC calculation. WACC calculation, we do it the same way. Debt, equity, value is, debt value is 5 lakh, equity value is 21 lakh 50,000, which translates to 26 lakh 50,000 in total. Weights, you can get the weightage over here and write down the cost also as cost of equity is 21.98 and cost of debt is 10.5. Cost of equity is 21.98%. And then we take the product. Product need to be calculated as KO. It should come out as 19.81%. Product will come out to be 19.81%. That's our KO. KO is 19.81%. That's the solution to question number 7. Well, good. This was model, which was the net operating income approach revised with the tax effect. Are we good with it? Shall we go for the next concept? Yes. Hiren, I'll be uploading the solutions after today's class because we have not yet done with these questions, right? So I've uploaded the question set. Solution file will be uploaded after today's class. Okay, fine. So 8, 9, they're all the same approach itself. Now, we have to discuss something about arbitrage. Arbitrage. Before arbitrage, let me take any queries if you have. How EBIT is same for both cases, irrespective of your capital structure, whether you take loan or not, your earnings before interest and tax will remain same, right? Because EBIT is not affected by how you fund your business, from where you have raised the funds. That's not considered in this, EBIT. EBIT is an operating number, so that's irrespective of how you raise the funds. Mansha, EBIT 1 minus tax rate upon value is equal to KO. Is it right? Yes, Mansha, you're right. You can do that. Okay, fine. Let's begin with arbitrage. What do we mean by arbitrage, sir? What do we mean by arbitrage? Arbitrage simply means looking at two different markets and trying to exploit the pricing differential. So trying to exploit the pricing differential in the two markets, that's what we mean by arbitrage. Okay, so let's say a share in BSE is trading at 950 and the same share in NSE is trading at 920. What will you do to get arbitrage profits? What will be your natural course of action to get profits? Two stock exchanges, but the share is same. At BSE it is 950, at NSE it is 920. So what will be your course of action so as to get benefit of it? Of course, you will sell in BSE and will buy in NSE. You'll sell in BSE and you will buy at NSE, right? Perfect. So when you do it, this will yield you a profit of 30. Correct? This will yield you a profit of 30. Now, as you do it, many others will also do it. So what will happen is there will be greater demand for the product or for this share in NSE, and there will be a lot of selling happening in BSE. Now, due to high demand in NSE, what is going to happen to the price? Price will increase, sir. What is going to happen to price over here? Price is going to fall over here because everyone is selling in BSE, everyone is buying in NSE. So in NSE, the price will go up, in BSE, the price will go down. And over a period of time, you will find that both of them are settling at maybe one single price of 930. And that's where you say that there is no arbitrage possible. At 935, we say there's no arbitrage possible, right? So this entire process of buying and selling in two different markets to get the price advantage is what we call it as arbitrage, right? So buying and selling is going to lead to stabilization of the price, and that entire process is called as arbitrage. It's a natural, any rational person would do, that it will buy in a less valued market and it will sell in the high valued market, right? So arbitrage, you should understand, it simply means buy from less valued market and sell in high valued market. Arbitrage means they're going to buy from less valued market and sell in the high valued market. Okay, so arbitrage simply means buying from a less valued market and selling in the high valued market. Now, there is this approach called as Modigliani-Miller arbitrage approach, which we are yet to cover, which is the next point that we are going to see. We have done net income. We have done traditional, we have done MM model with tax, we have done net operating income. Now one thing is left is Modigliani-Miller arbitrage approach. Now MM, they use this arbitrage concept to justify that the price is going to be same or the value is going to be same for two different entities. Yeah. Ansha is asking, what is the reason for the same stock being priced different in different stock exchange? Because of different demand supply. Different demand supply pattern, right? In the same locality, you will find price of a vegetable is high in one location, maybe 2 kilometers apart in other location, the price of the vegetable may be lower, right? So same way, because of the disparity in the demand supply, possibly the price may be different, but that price differential cannot be maintained for long because there will be always rational people who will undertake this arbitrage opportunity by buying in one market, selling in the other market, right? So that they get the arbitrage benefit. So over a period of time, the price has to be equal. Okay, so MM approach, they use this arbitrage approach to explain that value is going to remain same, right? So in MM approach, what we say is an investor will switch from a high valued company to a low valued company to get the arbitrage gain. Now, how is that arbitrage gain happening in the MM approach? How is that happening? Let's have a look at question number 10 and try to understand. See, question 10. There are two companies, N Limited and M Limited. There are two companies, N Limited and M Limited, having the same earnings before interest and taxes, that is EBIT of 20,000. M Limited is a levered company having a debt of 1 lakh at 7% rate of interest. Cost of equity of N Limited is 10% and of M Limited is 11.5%. Find out how arbitrage process will be carried on. There are two companies, N and M, having same earnings before interest and taxes of 20,000. That is EBIT of 20,000. M Limited is a levered company with a debt of 1 lakh at 7% rate of interest. So we are talking of two companies, N and M. So we know EBIT is 20,000. Interest rate is 7% of 1 lakh. 1 lakh loan is there in case of M Limited. So 20,000, from that we subtract 7,000. So we get a PBT or profit after tax of 20,000 and 13,000. Cost of equity is stated as for N Limited, cost of equity is 10. For M Limited, cost of equity is 11.5%. Cost of debt in N Limited is not applicable. And cost of debt for M Limited is 7%. What we have is value of equity. So value of equity will be simply obtained as PAT upon K, and value of firm will be value of equity plus value of debt. 2 lakh, 0, and then this 2 lakh, value of firm 2 lakh. For M Limited, K is 11.5%, KD is 7%. Value of equity is simply the PAT divided by KE of 11.5%, and value of debt is this, and value of firm is 2,13,040. First, let me know, are you clear with this table? Because unless you are clear with this table, unless you are okay with these numbers, we can't understand how the arbitrage is going to happen. So please clarify me. Please let me know, are we clear? Are we perfect with this table? With regards to the value and the cost of capital for both levered and unlevered entities. Are we good with this? Are we good with this, everyone? Are we okay with this table? Are the numbers clear? Yes. Okay. So we know the EBIT figures and we have computed the PAT figures. KE and KD is also given. Only value of equity and value of firm is calculated by using this form. So PAT upon KE, PAT upon KE for this. Value of debt is anyways given as 1 lakh and value of firm is also calculated. Yeah, fine. As I said, from amongst these, levered and unlevered, which company is having more value in this case? Which company is more valuable? Is it levered or is it unlevered? Which company is having a greater value, guys, in this given scenario? This given scenario, which company is having a greater value? The levered form, right? And what happens in arbitrage? We sell the overvalued, right? And we buy the undervalued, correct? In case of arbitrage, we sell those companies which are having high value and we buy those companies which are having low value. Correct, guys? Perfect? Yes or no? Yes. We sell the high value and we buy the low value, just as we did over here. We sold at BSE and purchased at NSE because NSE was cheap and BSE was costly. So over here, we are going to switch. Suppose we are an investor in M Limited. We are an investor in M Limited and we are switching from M to N. We are switching from levered to unlevered end. We are switching from levered to unlevered. So we will sell the levered entity and we will buy the unlevered entity. We will buy the unlevered entity. Okay. Now, since we are switching, we will assume that, let's say, an investor with 10% stake in M Limited, an investor who is having 10% shareholding in M Limited, an investor switching, the investor which is going to switch, it is going to be an investor who is having 10% shares in levered. Consider an investor with 10% stake in M Limited. Now we will see that if I switch from M to N, that is, if I sell my shares of levered entity and invest that money in the unlevered entity, am I having any additional income? So let us test whether switching investment from M to N will give any additional returns. Okay. So first term, suppose if I have 10% shares of M Limited and if I sell 10% shares of M Limited, can you tell me what will be the cash inflow to me? How much cash am I going to get by selling the shares of M Limited? How much cash am I going to get by selling the shares of M Limited? Of course, sir, when I'm going to sell 10% proceeds, 10% stake in M Limited, we will say 1,13,043 into 10%. So 11,304 will be the sale proceeds. So 11,304 will be the amount of sale proceeds. 1,13,043 into 10%. We will be receiving this much cash because we were holding 10% shares. We sold it. So we got 10% of this. Now tell me, your investment of 11,304, your investment of 11,304 in M Limited, was it having any debenture risk? Was it having any debenture risk? Yes, sir, there was debenture risk because overall value of 2,13,000 was derived as value of equity being 1,13,000 and value of debenture being 1 lakh. So for 1,13,000 equity, there was a loan on the company of 1 lakh. So if I was the equity shareholder in that company, my investment is 11,304. But sir, on this investment, there's always a sword. There's always a risk that is underlying. That is a loan of 1 lakh. A loan of 1 lakh. So on my investment of 11,304, I can say there was a loan of 10,000. Because if for 1,13,000 there was a loan of 1 lakh. So for 11,304, so the loan was there. Loan which was there, that is 10,000. Right? So we say there was a loan of 10,000 on which we were paying 7% interest. So to match the risk profile of both investment, we will take a loan of 10,000 because when you are invested in M, you were having a loan. When you will switch over to N, since it is an unlevered entity, there is no loan on it. So when you're putting money from M to N, you are actually changing your risk profile from a risky company to a non-risky company. And when you are switching from non-risky to a non-risky, the returns are not comparable. Because when you want to compare the returns, the risk also should be same. So for that purpose, to match the risk profile of both investment, we will take a loan of 10,000. Over here, we had an indirect loan on us. As the equity shareholder, we had an indirect loan on us of 10,000. And when we are going to switch, we will say, let us take a direct loan of 10,000 so that I'll take a loan of 10,000 at 7%. And the total funds that I'm going to have is 11,304 plus 10,000. So I'll have total 21,304 available with me. So how come this 10,000 has come? This 10,000 is to match the risk profile. Because earlier 11,400 investment was not without risk. There was a risk of 10,000, which was the indirect risk or the loan that the company was having. So to match that, we'll say 11,304 plus 10,000. The total cash that we have is 21,304. Now we will invest this 21,304 in the company in N Limited. Now when I'm going to invest this 21,304 in the company, the total company value was 2 lakh. The overall company value was 2 lakh. Out of this 2 lakh stake, I am going to invest 21,304. From 2 lakh, we'll say 21,304. That amounts to 10.652%. 21,304, that amounts to 10.652%. So by investing this, I acquire how much control over the new company? 10.65. Now let's look at what is the share of profits that we will get. Since the percentage is this, so PAT was 20,000. PAT was 20,000. PAT of 20,000. So 20,000. On that, you are earning that, like, your stake in 20,000 is 20,000 into 10.652%. So 20,000 into 10.652%, which means you are having a profit of share of 213. So can I take this 2130.4 home? That this my income? No, this is not your income. Sir, why can't I take this home? Because remember, we have taken a loan of 10,000. When we have taken a loan of 10,000, on that loan of 10,000, we have to pay 7% interest. 700 is the interest that you pay, and the net profit that you get from this new company is 1430.4. Sir, what was my income before switching? Before switching, the profit of the company was 13,000. On that, you were having 10% stake. So the profit that you were having was 13,000 into 10%, which is 1300. So before switching, when you were invested in the levered entity, you were getting 1300 as the profit. And in this new entity, you are getting 1430 as profit. So arbitrage gain is there, sir. There is an arbitrage gain, which is 130.4. Right? There is an arbitrage gain of 130.4. What's going to happen, guys, in the long run? In a long run, investors will be moving out of this levered company and they will invest in N Limited. So they will sell the shares of M Limited. Now, what will happen to the value of the shares of of the levered entity? It will fall. Value of shares of the unlevered entity will increase, and after a period of time, both the companies will have same level of debt or same level of the value. So the price difference or the value difference that we observe of 13,000 will one day we'll find that because of selling of company M and buying of company N, the price will be equal or the value of the two entities is going to be same. Okay, that's the primary arbitrage. That's the primary arbitrage. That is an investor investing or switching from levered to unlevered. Investor switching from levered to unlevered. Right. So arbitrage gain is 130.4. That's the primary arbitrage. Now, similarly, there can be a secondary arbitrage also in a scenario where the value of the unlevered firm is higher. So for that, let me take this example of A and B. A is unlevered and B is a levered firm. And taking these numbers, we get that the A is having a greater value, B is having a lesser value. Now the investors will switch from unlevered to levered. So same assumption, sir. Let us assume an investor with 10% stake in A wants to switch to B. So now how that switching is going to happen? First, cash you will receive on sale of 10% stake. Since the overall value of the company is 2 lakh, you own 10% of that, you get 20,000 for that. Now, this 20,000, if I invest only in equity shares of B, then the risk profile again won't be matched. Because when you are invested in A, there was no risk. And over here, if you're going to invest only in equity, then there will be an underlying or a indirect loan upon you. So what I do is to cancel that loan. So there is a loan on the company. So that loan is something which I need to pay if the company defaults. So to cancel that loan, what I do is, so let's do one thing, 10% stake in equity and 10% in debt. Because originally I was a 10% shareholder in A. So since I was a 10% shareholder in A, I will take 10% stake in equity. I will take 10% stake in debt also. So that the risk profile matches. Because even if I invest 10%, if I invest only 10% in equity, then the risk is not matched. Because 10% investment in equity will also lead to me getting exposed to 10% risk in debt. I don't want to take that debt. I don't want to take that risk. So what I do is I cancel that risk by investing in debt. Because if the company defaults, I can recover the money because I'm a debenture holder. Right? So that 10% stake is being used to cancel out. So what investment that we make is 10% of 72,222 and 10% of 1 lakh. That's amounting to 17,222. So to get 10% stake in the other company, we are going to invest this. Still, after liquidating 20,000, I'm going to invest only this. It means I'm still left with 2,778. I still have 2,778 left with me. Now, what is my income? Let's have a look at it. On equity shares, since the PAT was 13,000, on that 13,000, I'll get 10%. Since I have bought 10% of debentures, I'll be getting 7% on the debenture value. The total income is 2000. Total income of 2000 plus whatever surplus funds I have, 2778. On that 2778 also, I'll be getting some income because I'll be investing this at least at some risk-free rate. So my income is definitely greater than 2000. Sir, what was my income before switching? Before switching, your income was 20,000 with a stake of 10%, which was same 2,000. So my earlier income was 2000. Now my income is 2000 plus something extra. So does it make sense to switch from A to B? Yes, sir. It makes some sense to switch from A to B because you get additional profits or additional income. And so what's going to happen in the long run? Since everyone is going to switch from A to B, the value of A will fall, value of B will increase, and over a period of time, they both will become equal. And that's the arbitrage approach stated by Modigliani Miller. Okay. So with that, we are through with the capital structure. There is one trade-off theory that's pending. That we will be taking up in the next session, which is a revisionary session that we have for ratio and the capital structure. So in that session, we'll do some module questions, we'll do some extra questions, and also revise these certain things that are left out. Yep. So I'll wait for any queries, or else we'll call it a day. Yep. Any queries, guys? Raghavan, yes, both the companies need to be into the same line of business. Then only it's comparable. Because remember, I told you the risk profile should be same. Both the companies should be into the same line of business. Then only the arbitrage theory works. Any further queries? Waiting. Clear? Everything is fine. This approach is best when compared. Okay. Fine. There are no queries. Then in that case, let's just take a pause for the day. Let's get it done. We'll meet up tomorrow again on Tuesday, right? Yeah, Tuesday and Thursday. We have 2 more classes. So on Tuesday and Thursday, we'll meet up. We'll discuss in the next session, the revision session. Fine. So let's stop here for the day, guys. See you in the next class. Session complete, sir. Okay, bye-bye.